প্ৰিয় শিক্ষাৰ্থীসকল, কৃষ্ণকান্ত সন্দিকৈ ৰাজ্যিক মুক্ত বিশ্ববিদ্যালয়ৰ বিদ্যায়তনিক দৃশ্য শ্ৰাব্য অনুষ্ঠানটিলৈ আপোনালোকক স্বাগতম জনাইছো। স্বয়ং প্ৰভা DTH চেনেল 20ৰ যোগেদি শিক্ষাৰ্থীসকলৰ অধ্যয়ন কাৰ্য অধিক মনোগ্ৰাহী আৰু ফলপ্ৰসূ হোৱালৈ লক্ষ্য ৰাখি বিভিন্ন বিষয় সামৰি আমাৰ এই বিদ্যায়তনিক অনুষ্ঠানটি সজোৱা হৈছে। আহকচোন প্ৰিয় দৰ্শকসকল, আমাৰ আজিৰ খণ্ডটিৰ মাজলৈ আগবাঢ়ো।
Dear learners, I will be starting video lessons for the course Macroeconomics 1 of your MA first semester program. We begin this video series with the first unit of the course entitled National Income and Related Totals. This unit will have 2 videos, and this is the first part of the video. As you know, national income is one of the most important concepts in all economic systems. It contains consistent estimates of significant aggregates and components for the economy and for major economic sectors or groupings of decision-making units. It should be noted here that macroeconomics deals with economic and physiological forces, for example, aggregate employment, production, real income, and the price level. However, national income is a crucial preparatory parameter for tackling macroeconomic issues of unemployment, inflation, growth, and economic welfare, that is quality of life. Thus, national income, together with its related totals, is important for decision makers in our economy to shed light on the country's macroeconomic performance and to forecast events in the future. In this video, we shall try to look at the definitions and conceptual framings of domestic and national income. We shall also discuss various related totals of national income that are used to determine the progress of the economy. Basically, we will take it in the second part of the video. Now, domestic and national income. As stated earlier, national income serves as a background for economic appraisals and projections, and it also makes possible more effective public and private decision making. It attempts to measure how much economic activity took place during a specified period of time, usually a year. However, income of a country may be stated in the context of its territory and its normal residence. These 2 terms are very important. Let us now attempt to define domestic and national income and also try to derive conceptual explanations underpinning them. We have already stated that income of a country may be explained from 2 perspectives: its domestic territory and its normal residence. Here, the contrast between the 2 terms is very important. Domestic income can be defined as the sum total of factor incomes generated by all the production units located within domestic territory of a country during an accounting period, usually a year, as you all know. Here, we should note that factor incomes are expected to be generated within a defined territory irrespective of the status of the product, foreigners, citizens or foreigners. Within a defined territory, it is expected that both nationals and non-nationals reside. By implication, domestic income includes factor incomes of both nationals and non-nationals residing within a particular domestic territory. For instance, there are many foreign companies and banks which operate within domestic territory of India. This means income generated by these foreign companies and banks are included in India's domestic income. Therefore, the conceptualization of domestic income is territorial in nature, since it is defined with particular reference to domestic territory. We should clearly note that domestic income excludes factor income earned from abroad. Whereas national income is simply defined as the sum total of factor incomes earned by normal residents of a country in a particular accounting period. It is important to note here that the national income contains factor incomes earned by normal residents within and outside the country. National income is therefore framed along the lines of productive efforts of normal residents. Overall, income generated by both citizens, that is residents, and foreigners, that is non-residents, within domestic territory of a country is referred to as domestic income, while income generated by citizens, normal residents within and outside a particular country is referred to as national income. The major difference between the two is net factor income from abroad, which is added to domestic income to get national income. That is, national income is equal to domestic income plus net factor income from abroad. Now let us know some important terms here, two importance basically, net factor income and normal residence. Now net factor income is the difference between the aggregate income that a particular country's citizens and companies earned abroad and the aggregate amount that foreign citizens and overseas companies earn in that country. And normal resident, it means a resident is said to be a person or institution who ordinarily resides in a country and whose center of economic interest lies in that country. He is called a normal resident since he normally lives in the country of his economic interest. The period of stay should be at least 1 year or more. Here, center of interest, economic interest implies two things. Number A, the resident lives or is located within the domestic territory, and B, the resident carries out basic economic activities of earnings, spending and accumulation from that location. Certain items are not included under the category of normal residents. First, foreign tourists and visitors who visit a country for recreation, holidays, medical treatment, studies, sports, conferences, etc. Second, foreign staff of embassies, officials, diplomats, and members of the armed forces of a foreign country located in the given country. Third, international organizations like UNO, WHO, etc. are not considered as normal residents of the country in which they operate. They are treated as normal residents of international area. Fourth, employees of international organizations are considered as residents of the countries to which they belong and not of the international area. For example, an American working in UNO office located in India will be treated as normal residents of America. However, if the employees are working for more than 1 year in such international institutions, then they become the normal residents of a country in which such institutions are located. It means, in the given example, if the American is working in UNO office in India for more than 1 year, then he will be treated as normal resident of India. Fifth, crew members of foreign vessels, commercial travelers, and seasonal workers, provided their stay is less than 1 year. And sixth, border workers who live near the international border and cross the border on a regular basis to work in the other country. They are treated as normal residents of the country where they live and not where they work. Now let us briefly discuss some of the important aspects relating to another important concept, domestic territory. In layman's terms, domestic territory means the political frontiers of a country. In economics, the term has a wider connotation. However, for the purpose of national income accounting, it is used in a wider sense. Okay. In addition to political frontiers, domestic territory also includes, first, ships and aircraft owned and operated by normal residents between two or more countries. For example, planes operated by Air India between Russia and Japan are part of the domestic territory of India. Similarly, planes operated by Singapore Airways between India and Japan are a part of the domestic territory of Singapore. Fishing vessels, oil and natural gas rigs, and floating platforms operated by the residents of a country in the international waters where they have exclusive rights of operation. For example, fishing boats operated by Indian fishermen in international waters of Indian Ocean will be considered a part of domestic territory of India. Embassies, consulates, and military establishments of a country located abroad. For example, Indian Embassy in Russia is a part of the domestic territory of India. Consulate is an office or building used by a consul and officer commissioned by government to reside in a foreign country to promote the interest of the country to which he belongs. Now, important exclusions from the term domestic territory are, first, embassies, consulates, and military establishments of a foreign country. For example, Japan's embassy in India is a part of domestic territory of Japan. Second, international organizations like UNO, WHO, etc. located within the geographical boundaries of a country. Interestingly, according to the United Nations, economic territory or domestic territory is the geographical territory administered by a government within which persons, goods, and capital circulate freely. We conclude the first part of Unit 1 here. In the next video, we shall cover the remaining portion of the Unit 1. In that video, we shall take up national income and its related totals for discussion. Thank you. Dear learner, this is the second part of Unit 1, National Income and Related Totals, relating to your course Macroeconomics 1 of your MA first semester. In fact, this is second and concluding video of Unit 1. In this video, we shall discuss a few related totals and techniques economists use to measure the progress of the economy. We shall begin with the concept of gross domestic product. Gross domestic product, or GDP, is the total value of all the final goods and services produced within the domestic territory of a country during a period of time, usually a year. It is one of the fundamental indicators used to determine the health of a country's economy. Usually, GDP is used as a comparison to the previous year. For instance, if the year-to-year GDP growth is up to 4%, this suggests that the economy has grown by 4% over the last year. Basically, GDP represents economic production and growth, and this has a large impact on nearly everyone within that economy. An important change in GDP, whether up or down, often has a significant implications on the stock market. This suggests why it is not so hard to understand why a bad economy usually means lower profits for companies, which in turn means lower stock prices and negative GDP growth. Net domestic product. Net domestic product is a measure of the economic output of a country that accounts for depreciation. It is calculated by subtracting depreciation from GDP. In general, NDP accounts for capital that has been consumed over the year in the form of housing, vehicle, or machinery deterioration. The depreciation accounted for is what economists refer to as capital consumption allowance. Thus, capital consumption allowance represents the amount needed in order to replace depreciated assets. Now, GNP, gross national product. GNP is the value of all finished goods and services produced in a country during a period of time by her nationals. Both GDP and GNP try to measure the value of all goods and services produced for the final sale of in a particular economy. However, the difference revolves around how each term interprets what constitutes the economy. While GDP measures the domestic levels of production, GNP measures the levels of production of any person or corporation of a country. Depending on circumstances of each country, GNP can be either higher or lower than GDP. This depends on the net factor, income from abroad. The GNP comprises income earned by nationals and companies abroad, but does not include income generated by foreigners within the country. The figures used to assess GNP include the manufacturing of tangible products, that is cars, furniture, and agricultural products, etc. GNP does not consider the services used to produce manufactured products because their value is already included in the price of the finished products. However, depreciation and indirect taxes such as sales tax are included in GNP. Mathematically, GNP is private consumption plus government expenditures plus private investments plus exports minus imports plus inflow of factor income from abroad minus outflow of factor income from abroad. This gives us GNP. Now, net national product at factor cost and at market price. Net national product is the net value of all goods and services produced by a country's nationals, whether overseas or resident, in the period being measured minus the amount of GNP required to purchase new goods to maintain existing depreciation. That is, NNP is equal to GNP minus depreciation. It should be noted that NNP is expressed in the currency of the nation it represents. In India, the NNP would be expressed as an Indian rupee, whereas it would be expressed in euro for EU member nations such as the Netherlands. By definitional implication, NNP measures net output available for consumption and investment by consumers, producers, and government. That suggests that NNP is the same as the national income at factor cost. Products are sold at market prices, which include the indirect taxes imposed by the government. For example, indirect taxes are levied on commodities such as GST, on packaged food and cloth, and so on. As a result, the market value of the national product exceeds the income paid to the factors of production by the amount of indirect taxes. At the same time, some products are subsidized, which are sold below their production cost. Accordingly, the market price of these products is less than their factor cost. Because of these differences arise between NNP at market price and NNP at factor cost. We may express NNP at market price as follows. NNP at market price is equal to NNP at factor cost minus indirect tax plus subsidies. In India and majority of the countries, it is the NNP at market price that is taken as the national income of the country. Now, personal income. Personal income can be simply defined as the individual's total earnings from salaries, wages, and bonuses received from employment or self-employment during a given period. Personal income determines the consumer consumption since it serves as the indicator of future demand for both goods and services in the market. Now, disposable personal income. Disposable personal income is the total amount of money available for an individual to spend or save after taxes have been paid. Thus, disposable personal income is different from personal income in that the former takes taxes into account. It should be noted that only income taxes are deducted from the personal income figure while calculating disposable personal income. Now, relationship among the different related totals of national income will be discussed in the next slide. So here we can see the relationship among the different concepts of related totals. So for domestic income, it is actually rent plus wages plus interest plus mixed income plus profit tax plus dividend plus undistributed profit plus surplus of government sector, okay, when sold separately, or private sector. Or domestic income can also be derived from compensation of employees plus operating surplus plus mixed income, okay. And national income. National income is derived from domestic income plus net factor income from abroad. Private income. National income minus surplus of government sector plus all types of transfer incomes including national debt interest. Now, private income. Private income is equal to national income minus surplus of government sector plus all types of transfer incomes including national debt interest. Or private income is equal to income from domestic product accruing to private sector plus net factor income from abroad plus all types of transfer income including national debt interest. And personal income is equal to national income minus surplus of government sector minus corporate tax minus undistributed profit plus all types of transfer income including national debt interest. Or personal income can also be shown as private income minus corporate tax. Personal disposable income. It is shown as personal income minus personal taxes including miscellaneous receipt of government. Or personal disposable income can also be derived from national income minus surplus of government sector minus corporate tax minus undistributed profit plus all types of transfer income minus personal taxes. So we conclude discussion of Unit 1 here. However, for your conceptual clarity, we shall request you to complete the following assignments. Okay. So some short questions are there. Answer these short questions within 100 words. The first short question is make a comparative analysis between domestic income and national income. The second one is write a short note on net national product at factor cost and market price. Now, a set of questions include which you need to answer within 400 to 500 words. First is critically discuss the following terms GDP and NDP and write an essay on personal income and disposable personal income using yourself as an example. In the next video, we shall take up Unit 2 for discussion, which is basically on national income and related accounts. Thank you.
ইমান সময় আমি স্বয়ং প্ৰভা DTH চেনেল 20 যোগে সম্প্ৰচাৰিত কৃষ্ণকান্ত সন্দিকৈ ৰাজ্যিক মুক্ত বিশ্ববিদ্যালয়ৰ বিদ্যায়তনিক অনুষ্ঠানটিৰ আজিৰ খণ্ডটি উপভোগ কৰিলো। এই বিদ্যায়তনিক অনুষ্ঠানটিৰ জৰিয়তে শিক্ষাৰ্থীসকল নিশ্চয়কৈ ভালেখিনি উপকৃত হৈছে। পুনৰ আন এটি বিষয় লৈ আমি আপোনালোকৰ মাজলৈ আহিম। নমস্কাৰ।